Adjusted for purchasing power parity, China's economy has already overtaken the United States and the gap continues to grow. But for an economy dependent on exports, a trade war is a big deal. In 2024, Chinese exports to the US were over $500 billion. But so far, China has largely shrugged off the roller coaster of US tariffs. Exports to the US may be down 27%, but China is finding new export markets. As a share of global GDP, the US is in decline, China is on the rise. Now, when Trump announced the April tariff shock, China retaliated by implementing rare earth export controls. This, combined with a stock market crash, caused Trump to back down and reduce those very high tariffs on China. Rare earths and magnets are a critical ingredient in global supply chains. It is essential for everything from fighter jets like the F-35 to cars and the electronic industry. But even after the US reduced tariffs back to 35%, the interesting thing is China didn't fully reciprocate. It kept its export controls in place, meaning the US could only buy rare earths through short-term conditional arrangements. And last week, China introduced even more stringent rare earth restrictions. In response, Donald Trump threatened 100% tariffs. But the problem is that 80% of US rare earth materials comes from China, and without them, many industrial processes would grind to a halt. But the US threat of 100% tariffs caused another adverse market reaction, with share prices and the US dollar down, with analysts again fearing that the latest tariff threat could backfire on the United States. And kind of realizing the importance of rare earths to US industry, the US has had to back down and the new tariffs rolled back after just a threat of a few days. And it has certainly given the Chinese leadership growing confidence that they hold all the aces. The feeling that the US always seems to back down and the chokehold China has on manufacturing is very strong. However, there is a danger that China could also be overreaching itself and actually hiding several economic weaknesses. But first, a note about this video sponsor, PayTico. Money once stopped at borders. Today, payments move instantly across the world, reshaping how businesses trade, sell and grow. Borderless payments promise speed and convenience, but behind them lie challenges such as different currencies, local payment preferences, and costly transaction routes. PayTico solves this through advanced payment orchestration. By connecting merchants to over 500 global PSPs through a single integration and using tools such as smart routing, AI-driven analytics, and more, transactions are automatically sent through the most efficient and cost-effective providers, cutting delays, lowering fees, and boosting approval rates. From e-commerce stores to prop trading firms, PayTico gives businesses a unified way to manage payments, currencies, and settlements globally. The future of payments is borderless, and PayTico is helping businesses get there faster, smarter, and more securely. Now, whilst China does seem to be in a dominant position, it is worth pointing out several weaknesses to the Chinese economy. The property market has been a classic bubble and bust, leading to several zombie property firms and a rise in local government debt who bet on rising property values, and prices would have fallen more but for government price controls. Secondly, the ultra-competitiveness of Chinese manufacturing, which is doing a lot to harm US and European firms, is that partly due to excessive competition, the involution of industry, which leads to extreme price wars, overcapacity and falling returns. Local governments have a kind of incentive to support this excess investment through the prestige of new investment and more firms. But this leads to much weaker profitability, and it could lead to lower private investment in the coming years, especially with such weak domestic demand. Falling prices is also contributing to deflation, which can lead to a rising real debt burden and falling consumer spending. Chinese economic growth has certainly slowed down this year, and that's assuming that the statistics are not overstating actual output, which some suspect. Also, if we compare economies using raw dollar size, China is still less than the United States, and in recent years there are signs that the fantastic Chinese growth rates of the past are starting to falter. The long-held assumption that China will overtake the US in raw dollar terms is actually disputed for several reasons. China has falling fertility rate, its population is aging, and is now in population decline. By 2050, the share of the population over 65 will rise to at least 26% from today's current 12%. Already, China has a problem with excess domestic savings, a rate of 24% in 2024 compared to just 4% in the United States. And also going back to rare earths, it is true that China has a current monopoly on the refinement of rare earths, but the Chinese threats are encouraging frantic efforts to diversify, with greater production in Australia and the development of new refinement facilities. Greenland is also becoming a major player, and it would be ironic if Greenland could come to the US rescue in rare earths. China is definitely playing a trump card, but this will only stimulate competition to bring down China's monopoly in the future. The question really is, how long will it take? And also, reliance is not just a one-way street. China is still relatively reliant on high-end semiconductors, with the US blocking the export of NVIDIA's most advanced AI chips. However, although this ban will slow down China's growth, it's definitely nowhere near as critical as rare earths are to the US industry. But whatever may happen in the future, the statistics for China's growing dominance of manufacturing are really quite startling. China's share of global export containers is over 36%. Despite the trade war, China's trade surplus is on track to exceed $1 trillion this year. Despite domestic problems, its carefully cultivated supply chains with raw materials suppliers from Africa to Latin America. And as President Trump has found to his cost, a near monopoly in the production of rare earths gives it a powerful leverage over trade deals. Nor is China completely reliant on the US. Emerging economies are buying fast. China is dominating the production of industrial magnets, the new wave of renewable technology, batteries, electric cars, solar panels. Its car industry is the fastest growing in the world, and its goal of becoming the dominant manufacturer does seem to be in place. If we look at electricity production, we can see in stark terms the strength of Chinese economy in terms of industrial power compared to the United States. When it comes to renewable energies, China is leading the way. By 2030, it will account for 50% of all renewable energy in the world. But worth pointing out, it's also a global leader in coal power. Not very worried about the huge amounts of pollution, but it creates from its coal power stations. But the United States, by contrast, is turning its back on renewable energy projects, with many projects cancelled. Now, whilst the UK and US struggle to build high-speed railways, China has built 45,000 kilometres since 2008, more than the rest of the world combined. So at least for the moment, China has made itself indispensable in a key aspect of industrial production, and it does feel it has a trump card in rare earths. No pun intended. And I think it's fair to say there is great unease about China's dominance of global manufacturing. But at the same time, countries still want to have Chinese investment in new industries like batteries and renewable energy. And also, whilst a reliance on cheap Chinese exports is very damaging to many domestic industries, at the same time it's very difficult for consumers to switch. If you ever try to buy goods not made in China, you often find them more expensive. For example, if you want to buy a home solar power system, it would be at least 50% more expensive if you buy from a European or US firm rather than China. If Chinese exports were suddenly curtailed, it could increase the inflation rate by 2%, enough to cause significant discomfort. And even if clothing does say made in Vietnam, there's a strong chance at least a large part of it was manufactured in China before being sent to Vietnam for final assembly. Now, this video is mainly about China, but what about the United States? Because an interesting question is the US stock market failing to understand the structural changes coming to the US economy? Could the US economy actually be doing much worse than it appears on the surface? This video goes into that detail and that interesting question. Thanks for watching, and do subscribe, and we'll be covering the UK budget soon. Will it be good news or bad news? Well, don't hold your hopes up too much. Anyway, thanks for watching. See you soon. Bye.